Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. One area of interest we've been fielding more and more inquiries about are BDCs, or business development companies. And, if you think about the current market environment, it's with good reason. Income-oriented investors are faced with historically low yields. They're also faced with increased duration risk or interest rate risks. At the same time, you look over and you discover something like a BDC, and you see really attractive yields and a structure or an operation that allows an investor to potentially benefit from rising rates. And so that in itself raises a lot of questions. And so I am extremely fortunate to be able to welcome the CEO of the largest publicly traded BDC, Mr. Kipp deVeer. Welcome to the show. I think, the goal that I'd love to try to tackle today is helping investors really better understand how a BDC operates, how, with an average yield in the BDC market, if I look at a broad index of BDCs yielding over 8%, how BDCs in general are able to garner that type of yield. Some people might look at that and think that's too good to be true. What else? What are the risks? So what I hope to be able to do is identify how BDCs operate, talk a little bit about Ares as well, and give investors more insight and kind of summarize things at the outset here. What if I ask you to give your quick elevator pitch to investors considering investing in a BDC? What would that be?
Yeah, I think the elevator pitch tends to be there's inefficiency in private markets and in private market lending in particular, right? So our BDC, Ares Capital Corporation, is the largest publicly traded BDC. Typically, what you've seen in illiquid credit is the ability for folks that directly originate, which we do, i.e. we go direct to companies, and we take on the complexity that comes with originating and structuring our own deals, and also the known illiquidity in the transactions that we're doing to extract these premium returns, right? The baseline for how we price our deals tends to be, to where you're coming from, Ed, more liquid fixed income, right? Typically bank loans and high yield drive pricing in the private credit markets. But because of the approach that we take, where we do the origination, we do months of work with companies, getting inside and doing due diligence, and then take on the complexity and the illiquidity in those situations, we're typically able to earn higher origination fees, which we pass through to our investors and our shareholders at Ares Capital, but we can also take on higher yields for some of that complexity and illiquidity.
Well, how does that work? How does the financing of the deals work? Is it you go out and borrow at a low fixed rate and then are able to lend to small or middle market companies, private companies at a higher floating rate?
Yeah, today a snapshot of our company is we have a roughly $20 billion portfolio on the asset side, and we're invested in a couple hundred companies, right? So you get very good diversification as well on the asset side. The way that we finance ourselves, obviously, is we're a publicly listed 40 Act company with about $10 billion of permanent equity, obviously, with our listing. And on top of that, BDCs typically leverage themselves about 1-to-1. We've communicated in the past that the range we tend to be within is kind of 0.9 times our equity base to maybe as high as 1.25 times. We've been able to manage the liabilities, i.e. how we fund ourselves, in a host of different markets. So we have multiple secured credit facilities that are actually floating rate. But in addition to that, we've been able to term out a lot of our liabilities, to your question, with fixed rate unsecured debt that gives us the ability to push the duration of our liability structure out such that it matches our assets, right? So the weighted duration of our assets tends to be somewhere between 3 and 4 years. The liability profile, again, is matched at, around 4 years today. And the flexibility, to your point, is the markets offer different pricing, but yeah, today our liabilities tend to price somewhere in the 2 to 3% range, whether they're secured or unsecured financings, and depending on the market and, of course, the duration.
Now, a couple of years ago, new legislation was passed that allowed BDCs to take on more leverage, or I guess up to 200%. How has that helped your operation, and what does that additional headroom allow you to do?
Yeah, I mean, the first and easiest explanation is we haven't changed our operations all that much, but it did give us some nice regulatory relief. We felt quite confident that being able to leverage these portfolios in excess of 1-to-1 wouldn't actually provide any problems or difficulties in terms of managing the company. But it did introduce this risk that if we ever got on the wrong side of the 1-to-1, all sorts of terrible things happen, right? We have to suspend our dividend. We have to use our capital to pay down debt. So if nothing else, the regulatory relief has just given us some cushion, right? So we used to run at kind of 0.8-to-1 at a max to just manage against that 1-to-1 ceiling. By raising the cap to 2-to-1, it just allowed us to float more comfortably, either, slightly below 1, slightly above 1, but never with the possibility of having something terrible, right? Or some parade of horribles to happen. The reality today is, as I mentioned, we've changed the business model a little bit by increasing leverage and taking advantage of that low-cost debt financing that we are able to have. But the real, alpha for investors tends to come through, frankly, better investing, very substantial net interest margin. And while it provides a modest lift to ROE, and certainly makes us more comfortable running the company, it's not a huge differentiation in the business model. The only thing I'd add, just as a last reminder, we put that upper limit at around 1.25 times, just because that's where the rating agencies today tend to be comfortable with us as an investment grade rated company. And because we do term out a fair amount of our debt in the investment grade markets, that rating is important to us. And we want to stay within the parameters that the rating agencies feel comfortable with to maintain our investment grade rating.
So if an investor is looking at a BDC, what do you think the important metrics are to really evaluate? Can you look at a BDC and look at a lot of the traditional equity metrics, whether it's a PE ratio or price to book? Or are there other metrics specific to BDCs to really understand the health of that BDC and some of the risks associated?
Yeah, I think the mistake that gets made is that, frankly, folks are looking at the quantitative factors exclusively rather than the qualitative factors. For us, where we sit as an externally managed BDC being part of Ares Management, right? I'm the CEO of Ares Capital Corporation, but I also run a global credit group at Ares that has well north of 300 people and a 20-year history in the markets. We manage almost $200 billion of capital in our credit group. Most of the other platforms that you'll see running BDCs these days don't compare favorably to us on a whole host of qualitative factors that I think are critically important, right? Strength of platform, quality of management team, how long have they been doing this? How long have they been doing it together? Every BDC says they originate their own loans, but that probably means different things, right? Depending on how many people you have, where they live, which industries you focus on. We've put the largest origination and investment team against our BDC in the space as we've grown and continue to invest on behalf of shareholders behind that growth, right? So before we even get to metrics, I think there are a bunch of really important, those are some of them, not all of them, qualitative factors that folks need to try to get through. But yeah, on a quantitative basis, we don't view the long-term track record of the BDC any differently than we would a private fund for our investors, which we run at Ares. And simply, we're looking at the total economic return that we're able to deliver to investors. So a portion of that comes through the yield that you were referencing, but a portion of it comes through NAV accretion. So for us, we show in our prepared materials and quarterly decks to folks that kind of comparison to other BDCs, and it reflects very well on where we sit in terms of economic return to shareholders, right? Unfortunately, some BDCs and other direct lenders will be achieving, to your point, that premium yield, but it's coming with credit losses. So you're getting a lot of income, but the NAV of the company or the fund is going down, right? Which is, of course, taking away from your total economic return. So we really try to get everyone focused from a metrics perspective on what's the total ROE that we're able to develop to shareholders over a long period of time. And I think we sit pretty close, if not at the top of the heap in terms of that. But yeah, to your point, the common valuation metrics that I think you would see is what's the yield, i.e. what's the dividend yield divided by the stock price, and then how do we trade as a multiple of book value.
From a portfolio standpoint, I'm also curious if you have a sense of what systematic risk factor one can compare to the price performance that one might see in a BDC. Is it are you more related to credit default risk or small cap risk? Do you have a sense of what factors might have a higher correlation to general BDC prices?
I not being somebody who buys public stocks for a living, but we do run a couple of public companies, Ares Management included. I can't say that they always trade on fundamentals. I think that there's some misconceptions, but to answer your question directly, the BDCs should be trading on potential for credit risk, right? They are positively inclined to higher rates, and that most of our assets are, LIBOR or SOFR plus assets. So as the base rate goes up, we start generating more earnings, right? The cost of our funding doesn't go up as much because a portion of it's fixed rate. So rising rates actually have a positive effect on this company, not a negative effect. And a lot of financial services investors are not used to that, but it's true of the BDCs. But yeah, the way that we try to describe credit performance and exposure to credit risk is we run an unbelievably diversified portfolio, right, which we think cushions investors from any, defaults or credit risk that we're inevitably going to have in the portfolio, right, as you go through time. And the way that we discuss the health of the portfolio is twofold. We publish a quarterly non-accruals number, which is companies that are not performing, not paying us interest. And then we also publish portfolio grades for the entire portfolio on a 1 through 4 system. You come in at underwriting as a 3. If you're exceeding budget or expectations, you become a 4. If you're underperforming expectations, you become a 2. And if you're materially underperforming, those are our real problem names, you become a 1, right? So it's easy to get a sense from us based on the health of the portfolio simply by looking at that percentage grading system.
Some might argue that rising interest rates might be a headwind to some of your portfolio companies. Where's the balance there? I mean, I understand that a lot of the deals are structured on a floating rate basis, and that's good for the portfolio, but that becomes more expensive for the companies that have borrowed, right?
It does eventually, although I don't think that we're remotely close to a rise in rates actually creating weaker credit performance inside the portfolio for a couple of reasons. First and foremost, most of our borrowers today are actually paying our interest with a LIBOR or a SOFR floor that tends to be set at 75 basis points to 100 basis points. So they're already servicing debt as if the base rate were 1%. The bad news for us is we don't get any direct pickup on the assets as LIBOR kind of approaches 1 and has to get up above 1 for us to see the earnings benefit. The good news is none of our portfolio companies are currently being shocked by what's been a pretty rapid uptick in LIBOR or SOFR over the last 6 months. But I'd say even beyond that, just as a kind of number 2 from philosophy, we tend to set up most of our underwritings where interest coverage in the portfolio, i.e., profits divided by debt service, are well in excess of kind of 2 to 2.5 times. So we have a lot of room, right? And as an underwriting matter, we do, and maybe this is just because we're old school and we've been doing it a long time, we do like to set up our underwriting models to actually show companies with flat revenue growth and see if companies can actually generate enough free cash flow to pay down debt, even if there is no growth. So we think we've underwritten the portfolio pretty conservatively, and that there's good interest coverage inside the portfolio companies. If LIBOR were to get up to, or SOFR were to get up to, 4%, could that create some pressure? Probably, but I think we're a long way from getting there, right?
One of the other, I think, attractive aspects perhaps of BDCs is the whole trend towards private credit. Have you seen that play out and be a tailwind for your business?
No, I think the market for private credit broadly has expanded, exponentially over the 20-something years that I've been doing this, and with a couple of my partners. It used to be a bit more of a cottage industry, really financing smaller companies only that the banks weren't interested in. And over the years, what's happened is the banks have continued to get larger and consolidate, and the minimum size of a transaction that they would do just kept moving up and up and up. So the folks that have been leading the growth in direct lending, like Ares, have continued to fill that gap, right? So when we started, in 2004 with a much smaller company, the market that was available to us was really financing probably 10 to 50 million EBITDA companies. So you're thinking about companies that are worth somewhere between, 100 and $500 million. Well, as the banks have stopped financing that next set of, call it 50 to $250 million EBITDA companies with substantially more enterprise value because it doesn't fit with their business model, and it doesn't fit a lot of the regulatory constraints that they've had. We have, along with some other folks who saw the market opportunity expanded, raised capital so that we could do larger and larger transactions, right, to fill what we thought was an expanding and exciting market opportunity. And that's what's led to the scale. So our fairway has gotten wider. We haven't left behind the smaller, 50 to $100 million financing. But now, as you'll see in the press, it's not uncommon for Ares or Ares plus a couple of others to do a multi-billion-dollar bought deal, particularly, with private equity funds.
Can you talk a little bit more about the evolution in the banking system? What was it, or was there a particular event that caused them to kind of move away from this market, or was it just the consolidation?
I think first and foremost, it was scale, right? So when you think about like a JP Morgan today, who's a great relationship of ours, significant counterparty, and I think the very clear leader in large cap leveraged finance these days, their goal is to do 4, 5, 10, $20 billion leveraged finance transactions, right? That are easy to rate and syndicate and kind of move on to institutional investors where there's true aftermarket liquidity. It's really scale more than it is anything else. The smaller deals, just as they got larger, stopped moving the needle for them, right? And the folks who filled in below them over the years in terms of banks tended to be foreign banks, because Wells Fargo and Bank of America and Citi had some of the same considerations. Places that my partners and I tended to work after I started my career at JP Morgan was we all moved out of the US banking system to work at foreign banks because they were still interested in doing these slightly smaller deals. That really went away during the great financial crisis, and it really hasn't come back. And the reality is most of the talent that were sitting in banks 20 years ago are no longer sitting in banks and are probably sitting at a firm like Ares today doing what we're doing. And the whole market has really shifted away from being a bank-led market from 20, 25 years ago to being an investor and institutional platform-led market, which is obviously how we've positioned our company.
So you don't envision banks coming back into this market or being a competitor?
We don't. The way that we see them most active actually in the middle market today is they're a lender to us, right? So I mentioned that we have secured facilities at Ares Capital Corporation. Our largest lenders are those U.S. money center banks because it's an investment grade rated loan. They can do it in size. They don't need to put a lot of resources against it. And they've found over time that, these large teams that are doing middle market lending and principal investing really are not a fit in their business model. And the way that they access the market today is by lending to platforms like ours.
How would you characterize the state of the middle market? And when we talk about the middle market, what are we talking about? We're talking about companies with revenues of, in one case I read, 10 million to $1 billion. How do you look at what the middle market is?
It used to be pretty clearly defined as 50 million of EBITDA and below, right? You were talking about a couple $100 million financings that were difficult to get done in public markets. That's where the private direct lenders came in to really create the business, 20-ish years ago, making it easier to buy companies and to do acquisitions and provide growth capital. But again, the fairways expanded a lot, right? I don't have the data set right in front of me, but I think in the fourth quarter on our earnings call, we mentioned something like the smallest company that we looked at had 10 million of EBITDA and the largest had, almost 400 million of EBITDA. So it's a pretty broad fairway that's supporting the growth opportunity. We publish 2 stats to try to get folks there. And I think we're a little different in this regard because of our scale. So we show both a weighted average, but also sort of a median average EBITDA, which has trended up for us into the 100-ish million range, right? So you're typically talking about businesses that are worth $1 billion plus on average, which is kind of our target hunting ground these days. And that's not true for many of the other BDCs, which are much, much smaller, don't have the resources either in terms of capital or people that we have. But we do want to be flexible and user-friendly to our potential clients and portfolio companies. So we do still cast that very broad net. And we're serious about it. We're happy to finance a $10 million EBITDA company. And if there's one that's, 500 million of EBITDA looking for 3 or 4 billion of financing, we can do that too.
What do you think some of the biggest challenges are for the middle market companies going into, the next half of the year or a year or 2 years out?
Yeah, I think the questions that at least we're asking ourselves these days, and I think our companies are too, is with the supply chain disruptions that we've seen and the inflation that's very real, right? I think the question for the back 9 months of this year from all of our companies and me and everybody else is, can the consumer, which has largely driven the recovery, right, in the economy out of COVID, can the consumer support these price increases? Or does it actually have a hit on volumes, right? So most of the places where we see that inflation, and it's real. I mean, you see labor inflation, you see commodity price inflation in a food company or a company that makes, consumer products like shirts and socks and whatever else. It's very real, right? And then it's coming through. So if you raise prices, does that actually dampen what we all expected would be sort of the volume growth, right, in terms of demand side? And I think that's what companies are trying to solve for. We typically underwrite most of our companies that have some commodity exposure as ones that we also think have a lot of pricing power, right? That's how they maintain their margin if they see cost side inflation. But I think we're all going to find out here whether the consumer can actually take on this amount of inflation. And it's kind of happening right now, right? We're all reading about it, but a lot of these price increases went through last year. Companies were hopeful that was that. And then things didn't improve and they had to put through another set of price increases. And, we're just starting to see February financials from companies, but I think that's the big question mark, right, for what we see in Q2 and Q3.
But you see inflation as being somewhat persistent, not just a fad.
Right now, to me, it seems like it's reasonably persistent, yes.
If you talk about the volume of opportunities that that I imagine you review on any given year, what volume of opportunities or deals do you actually take on or invest in?
That's sort of the hardest part of our job, and that we're actually out casting a very wide net. We believe that seeing the most deal flow actually allows us to be very, very selective, and we think that leads to better asset selectivity and inevitably at the end of the day, performance on the asset side. The problem is, to answer your question directly, we say no about 95% of the time. Our close rate is literally less than 5%, and it has been for a long time. The way that we've managed it well is, again, we're clear with people up front in terms of what we're looking for, deal flow wise. And we've been very good about, the quick no's. So if we source something that we know is not a fit, we can tell a counterparty quickly that it's just not a fit. We look at, I think last year the number was over 2,000 deals. We'll close less than 5% of those. Before we jump off this point, I'll just make one other point. One of the things that makes that easier is the fact that we have a large diversified portfolio. So about 50%, we call that sort of the incumbency advantage, but about 50% of the investing that we're doing with our existing portfolio companies. And we know how they're performing. They're looking for more capital. They're looking for growth capital. And we have the ability to kind of continue to bet on our winners, which I think is a huge advantage. And it frankly makes it easier that we only say yes about 3 to 5% of the time on a true new deal. But we still want to crank that origination engine because we think it's important to see the most deal flow you can possibly see, and to mine what we think are the best ones.
Will you guys make equity investments as well? I know most of the portfolio is on the credit side, but will you take on equity positions?
We do. We won't buy a company. We tend to make co-investments alongside our debt investments. I don't want to say in most, but in many of our investments. And we've had a very good track record doing that. The lending business is hard because you're going to, again, charge fees and your goal is to earn, a coupon and get repaid at par, right? So the risk is really asymmetric to the downside, right? It's almost impossible to run a lending business without creating some losses over time. The good news is we've been able to minimize those losses, which is one of the keys to good performance on the asset side. But the other way we've been able to counteract those losses has been to generate gains, right? That's been one of the ways that we've actually been able to build the NAV of the company, both on performing companies, but also on some of the restructured names where you've had to go in and take equity stakes and turn businesses around. I actually do believe, we believe as a management team that it's very important to have some portion. It tends to be 10 or 15% of the portfolio. It actually gives you some upside in these portfolio companies, such that when they do well and they eventually exit the portfolio, you also exit with some gains for the benefit of the shareholders. And we've shown over a long period of time that we can do that well. And it's been a contributor, a differentiator of our performance for sure.
I wonder, since the last real crisis, which we're just kind of coming out of COVID, I wonder if you can talk a little bit about how Ares managed through COVID to give some perspective of perhaps a really critical time in our markets, just to give a sense of how you guys managed it and perhaps some understanding of how BDCs might come through the next cycle or credit event, things of that sort.
Yeah, I give the team a lot of credit because I think we managed it incredibly well. But we also, having managed the company through the great financial crisis too, we actually learned a few things, back then. The most important being, and I referenced this before, diversifying your liability structure and terming your maturities out. I always refer to it as BDCs 1.0, i.e. pre the great financial crisis. Way back when, we didn't really have the benefit of such diverse funding sources. We were relying on shorter term secured financing that tended to be shorter than the average duration of the assets. And the fear back in 2009 was that, we'd have a margin call or the banks would foreclose on collateral or whatever it may be. And having lived through those moments where none of that happened, we said to ourselves, we really don't want to be in that position again. And as we got larger, we were able to get the liability structure to support the assets, in a way that we would have loved to have done 15 years ago, but frankly didn't have the benefit of in either the markets or in terms of the company's scale. So we went into COVID to try to move this along a little bit too, with just a much, much better right side of the balance sheet than we'd ever had. And that was super, super important because we did have a period there where we had some fair value markdowns, right? Not losses, but write-downs in asset value because companies were underperforming because obviously they were closed, right, during lockdowns and periods of time there. But we didn't have such reliance on secured financing that, when the banks asked us to post more collateral, we said, sure, no problem. We're massively, over collateralized in terms of what we need to post to secured facilities. We could easily post collateral. We had access to liquidity the entire time. It allowed us to support companies. It allowed us to be out doing new deals, which were unbelievably attractive, right, during that, call it 12 to 18 month period as we were trying to get out of it. So first and foremost, I think the company was set up well from a liability standpoint. We talked about the defensive industry positioning as well. I think that we had a very healthy, again, defensively positioned portfolio going in. That being said, COVID threw us some curveballs, right? We're financing things like a series of dental practices, right? There were some things that were obviously going to be impacted if you were oriented towards hospitality or leisure travel or the airlines or whatever. But I don't think it occurred to us until maybe 2 weeks in that, dentist office were going to be closed for 90 days, right? If we did a deal back in 2017, that's not something that was in our underwriting memo, that we had a pandemic and the company closed for 6 months, right? The same's true of some of the restaurant investments that we've made. So we were definitely challenged on the asset side to really go in and show that we knew how to be a constructive partner to these companies and figure out how to get them to the other side. And for me, it was just a message to the team, and I think from others too, this likely won't last forever. It's going to require a different playbook than we've been used to in the past. And we developed a COVID playbook of trying to be a value-added partner, look to the equity in a lot of these companies to support liquidity needs to the extent we needed to make some concessions because companies literally had no revenue for a quarter at a time. We did that. But we believed, and I think the metrics today would show that to be true, that we were invested in a bunch of great companies that, like everybody else, was going to have to survive those COVID lockdowns. But when they got to the other side, their profitability would likely bounce back to where it was in 2018, 2019. And that's largely what's happened today, right? So the team worked incredibly hard. We, like everybody, sat here on Zoom calls, working around the clock for frankly most of the month of, March, April, and May of 2020. It was tough. Team was really beat up, but they did a great job, and we figured it out. And I'm shocked, frankly, that it's 2 years later, and I can say that we've got the best credit metrics than we've seen in the company in years. If you'd asked me in March of 2020 if I thought 2 years from now we'd be in the healthiest credit position we've ever been in, I would have said absolutely not. You're nuts, right? But things have kind of come roaring back.
Do future pandemics weigh in on future deals now and thinking through that? And in that regard, also the risks associated with, say, climate change or ESG risks, has that factored into your business these days?
Well, I'm hopeful there is not going to be something else like the 3-month period in particular that we all endured 2 years ago. Look, it's at least now in the memo, right, that we had this pandemic and this is how companies dealt with it. It's still in most of our memos. My wife, who watched me sit in the same room for that period of time, is like, every time I walk past your office, it's this. But the COVID did this to this company. The COVID did that. So it's at least in the memo. I don't know if it's part of a legitimate underwriting case, but it's at least now on the table for the conversation, right? There are lots of other factors, to your point on ESG, that I'd say are increasingly important to our shareholders and investors, have always been important to us, frankly, at Ares, but I think it's something that we've spent more time on to institutionalize. And the pandemic was a great sort of galvanizing backdrop for people to say, life isn't all about hard work and money. We actually care about other things like climate change and like DEI issues in the company. And Ares as a manager spent a lot of time, frankly, galvanizing around these issues because we saw them becoming increasingly important to our employees. The pandemic, I think, did change, as we've all read about, a lot of people's worldviews and priorities. So we've been hiring furiously, since just before COVID, actually, a new head of corporate DEI at Ares, a new head of ESG. We've actually started a foundation at Ares to build on the philanthropy that we were already trying to bring to companies and communities where we obviously live and work. They're all CEO level reports into my partner, Mike Arrighetti, who's the former CEO of Ares Capital, is now the CEO of Ares Management. So very important to us, but have become of increasing importance, I think, based on the world that we've been living in the last couple of years.
To close out, and perhaps given your perspective of all the different companies that Ares invests in, I like to ask, what's one long-term trend you see playing out over the next year or several years? It could be about BDCs in general, or it could be about something else that's just kind of top of mind that really interests you.
Changed and will continue to change has just been the amount of technology that we see and its importance to companies in every industry, right? It's one of the reasons why we decided we needed to get much smarter on software 10 years ago, because every business, and we certainly saw this during the pandemic with the run up in, Zoom and Peloton and whatever else, it's just crept into our lives in a way that has materially changed things, right? We're obviously doing this podcast, here together on a Zoom call. That probably wouldn't have happened a couple of years ago, and it's just one example. But I do think that as technologies become more evident in every aspect, it has to make you think a little bit about, what does it mean for travel? What does it mean for hospitality? What does it mean for other businesses that are experience-based? So just as the landscape for investing changes, I think that would be the hardest thing for us to not acknowledge as being just very different from where we were 10 years ago.
Well, Kipp, this has been great. Thank you very much for your time and your insights.
Ed, it's been great. We really appreciate you guys doing this with us, and hopefully we'll get a lot of listeners, a lot of viewers, right?
Yeah, absolutely. With that, I'd like to say thank you to the listener for tuning in to another episode of Trends with Benefits.